Hey guys, Gerald back at again with another video. In this video, I'm gonna go over my top 5 stocks for April here. So without further ado, let's jump right in. So first company I want to look at is inspired by Stanley Druckenmiller. We're gonna be looking at SC Limited here. He looks like he increased his position by 244%, an addition of over 669,000 shares. He's down about 31% with an average price of 124.66. Looking over this company fundamentals, this is a high growth, highly volatile company from Southeast Asia. It is a tech conglomerate trading at a significant discount, but that's for a decent reason. It has intense competition, and they also have a recent pivot to profitability here. Right now, the company is trading a compelling 36.7% discount to its calculated intrinsic value, right? So it's offering a significant margin of safety here. This is a company that is exploding in terms of revenue growth of 28.8% per year, but that's also paired with razor thin net margins, 2.6% of which. And ultimately, they are pivoting from one that was having a lot of deep losses to now profitability here. So now it's about this company navigating through profitability. And are they able to sustain this profitability and growth as well here? Wall Street seems to think so, with an average price target about $183, suggesting about 113% upside for us here. So I'm going to go over the bull case, the bear case. I'm going to go over the technicals as well as any dark pool data that's been going on for this company here. Bull case, there's a lot, right? This company is extremely undervalued and displays strong growth here. They are about 37% discount to its intrinsic value of 135. So that's a huge margin of safety. And they also have a dramatic turn to profitability. They had a loss of 1.65 billion in 2022 to now a profit of 444 million in 2024, right? So this demonstrates improved cost discipline as well as being able to scale. They also have a dominant regional platform. Shopee's e-commerce platform is the #1 player across Southeast Asia, which benefits from the first mover advantage and powerful network effects as more buyers and sellers join that ecosystem. They also have a strong balance sheet with an interest coverage ratio of 17.3x. This company can comfortably service its debt and now has begun to return capital to shareholders via a 14.5 million share buyback program. The bear case for this: they have intense competitive pressure. Sea operates in brutally competitive markets. Shopee is facing off against Alibaba's Lazada. So there's always a constant margin pressure that's been going on. And that's what's the difficulty is if this company can maintain already its thin margins here. The second is the earnings volatility and a recent miss in its earnings here. So recent Q4 2025 earnings miss on earnings per share as well as EBITDA due to the higher credit provisions triggered a 16 to 26% stock sell-off. You're also with rising credit risk here. The rapid expansion of the C Money's loan book is up 80% year over year, comes with a lot of growing pains, right? So credit losses surged by 67% to nearly 400 million in the last quarter. So that's going to pose a direct threat to the company's profitability. The company is also with a growth guidance reset. Management guidance for 2026 suggests flat adjusted EBITDA versus a 2025 levels, which is a disappointment to a lot of analysts where they expected a lot higher growth for the company here. But that's been expected with a lot of companies. That's been going on throughout the entire market here. So this is a company with high volatility as well. Big moves to the upside as well as the downside here. So be cautious when you're looking into buying into the stock here. So once again, SE is a play outside of the United States. So if you're looking to essentially hedge your portfolio against the United States market, where it's been extremely volatile with news of potentially even war, you're seeing a lot of investors invest into emerging markets or just elsewhere outside of the United States here, whether it's in China, whether it's with India, whether it's with Korea, and so forth, right? So once again, the intrinsic values presenting about a 36% upside for the company. Average Wall Street is over 100% with the lowest price target over $120. We had significant super investor and hedge fund involvement, one of which, like I said, was with Druckenmiller, and I'm going to be going over a couple of other hedge funds as you guys can see here. We have Ray Dalio here with 195 million. He decreased his position by about 4%. He's down about 36%. Stephen Cohen also increased his position by 194%. He has about a $625 million into his position, also down over 30% in his position. John Overdeck increased his position by 18%. He has about a $185 million position into SE here. We have Jim Simons also with 147 million. So we're seeing a lot of significant super investors pour significant amount of capital into Southeast Asia stocks, as you guys can see here. Looking at the company on the daily time frame here, it looks like we're on the lower side of the Bollinger Band. Selling has been weakening. RSI is sitting at around 31.25. So if we can get some support and a bounce around this level here, which seems to be sitting roughly around a golden retracement. I'm just going to go ahead and mark this place out here. We're sitting at golden retracement. If we can get a third wave move up, this is going to sustain or support a MACD crossover to the bullish side, as well as an inflection towards a positive RSI here. I'm just going to take a look quickly at the weekly time frame. We are completely oversold on the weekly time frame with an RSI of 27.91. So I do expect some level of dead cat bounce from where we're currently sitting at here. As you can see here visually, the average price target and as well as the high price target for analysts is significantly away from where we're currently sitting at. So it's providing a decent margin of safety, as well as being like I said, a hedge against the United States market here. All right, next stock I want to look at is S&P Global Incorporated here. This is a high quality financial data and analytics powerhouse. It is a premium business trading at a premium price, offering about a 3% of margin of safety for value investors here. So S&P Global is a financial fortress, converting nearly 30% of its revenue into net profit, generating over $5 billion in annual free cash flow. This is a company with a PE ratio of about 28. So the market is essentially pricing in quality as well as growth, with not the best margin of safety here, with about a 3% margin of safety here. Wall Street, however, is unanimously bullish with an average price target of over 40% above the current price here. I'm going to go over the bull case, the bear case, some dark pool data for you guys for this company as well, and whether I think the stock is a potential buy here. So the bull case for the stock, this is a dominant market position with recurring revenue here. S&P Global operates essential, hard to replicate services like the credit ratings. So the S&P ratings that you see out there and market benchmarks, such as the S&P Dow Jones indices, this is the company that's responsible for that, right? So they have a powerful recurring revenue stream that's ultimately critical for daily financial decisions here. We also have exceptional profitability and cash generation. The business is a cash machine with a nearly 30% net margin and $5.46 billion in free cash flow. In contrast to what you saw previously with SC, this is a company with a lot higher net margins here with about 30%. And they also are buying back over $5 billion in stock in 2025. And they raised their dividend for the 53rd consecutive year here. They have a strong growth trajectory and they guided upwards. Revenue has grown from $11.18 billion in 2022 to $15.34 billion in 2025 here. So management's 2026 guidance calls for about 6 to 8% organic revenue growth and an earnings per share of 19.4 to 19.65 here. AI is also a future growth catalyst for the stock here. Management is actively positioning artificial intelligence as a key driver for future growth, which could unlock new data products, improve efficiency, and deepen its competitive moat here. This is also why a lot of other companies, S&P Global being one of them, having a downturn in their stock price. The sort of competitive pressure or the worries, artificial intelligence. We also have confident insiders in Fortress balance sheet here. There's been recent insider activity, shows they're buying the company rather than selling the company here during its lower valuations here. And they also have a very manageable debt level with a debt to equity ratio of 0.42 and an interest coverage of 21.5x here. Bear case for the stock is that it's not necessarily trading at significant margin of safety here. This is a company that's trading with a PE ratio of 28 with an EV to EBITDA of nearly 19. So essentially market is potentially pricing it fairly where it's currently sitting at here. There's been a lot of recent stock weakness. So sentiment has been weaker for this company here. And this is a company that's economically sensitive, right? So in periods of economic downturns or freezes in debt issuance could pressure the company's revenue growth here. There's also concern of execution risk because the company did guide upwards or had a positive and upbeat guidance here. So the company's own guidance for 2026 is ambitious and fair to meet this, especially on the margins and earnings per share, could disappoint investors, and not having that substantial margin of safety could impact the stock here. So looking at the company's intrinsic value, we're currently trading roughly around fair value around right now, with Wall Street predicting about a 482, so about 14% upside, as well as average Wall Street analysts being 593. But overall, we have a consensus buy with SPGI here. Looking at these super investors here, I'm going to identify some key super investors here for us. We have Israel Englander here, who has a $550 $14 million stake into SPGI here. He increased his position by about 47%. We also have Ray Dalio here. He has a $40 million stake into SPGI. It increased his position by 179%. He's down about 15% in his position here. Phil Lafont initiated a position here last quarter, has a $33 million buy into the company, sitting around 493. So he's down about $493 here. So decent margin of safety for these super investors that just bought into the company. If I can buy it a little bit cheaper than them, that's great. We also had a recent insider buy from Jolie Hubert here, who's the director, who bought nearly $1 million worth of the share here on February 10th here. It looks like she bought it around $398. Looking at SPGI on the daily time frame, we are sitting roughly below this middle Bollinger Band, finding support around this area here. RSI sitting around 38.41. Bullish momentum has been weakening. We want to see some level of bounce around this area here. So we are currently sitting at golden retracement. I do expect pop-up for this stock going into this week here. The third stock I want to touch on for today is United Health Group here. This is a healthcare giant, right, with near-term headwinds, trading a significant discount to its intrinsic value, offering about a 31% margin of safety here, and a 3.1% dividend yield for those who want to hold this for the long term here. So United Health Group is a financial powerhouse with over $400 billion in revenue and a $17.4 billion in annual free cash flow. But ultimately, its story is currently clouded. A projected 2% revenue decline for 2026, which is the first time in decades. And after a sharp 36% drop in net income, has spooked the market. And now the stock has essentially has PE minimization towards a low of 14.6 here. Wall Street, however, is largely bullish with an average price target of $397. So that's ultimately, for even my valuation model, it's pricing in the stock as deeply undervalued here. Bull case for the stock is its massive scale and financial fortitude. $400 billion in annual revenue. You're not going to get much companies producing that in terms of profit and free cash flow here. So $70.4 billion in free cash flow. They are able to fund a dividend and ultimately fund into growth areas like Optum, right? So there's a lot of cost-cutting measures that the company is able to institute to drive up and provide shareholder value here. Once again, the stock is undervalued, right? The stock is trading at about a 30% discount to its calculated intrinsic value of 410. It's trading at a PE ratio of 14, has an earnings yield of 6.9% here. So they are also with new leadership under CEO Stephen Hemsley, right? So he's making tough but necessary actions, right? So they're shedding the unprofitable Medicare Advantage members and implementing AI-driven cost cuts, right, to ultimately improve their margins from what's been going on and driving the stock down currently here. They also have a very diversified business model when you compare this to a lot of healthcare stocks here. So they have the Optum segment, which is their health services, which provides a crucial growth engine and that diversification from just the purely insurance side of things. So when you're looking at stocks like Elevance or Molina Healthcare, this is a company that's a lot more diversified than those insurance companies alone here. We also have high analyst conviction. Despite recent downgrades, 89% of covering analysts maintain a buy rating with an average price target over 40% from current levels. Bear case for this company here is projected revenue decline. Company in management is guiding for 2026 revenue that is to drop about 2% year over year. So the first annual revenue decline since the 1980s, right? They also have a lot of regulatory and legal overhang. The Trump administration, as well as the Department of Justice, is pretty much causing a lot of compression into the stock, right? So there's a lot of scrutiny, a lot of uncertainty for the stock going into April here with a lot of the Medicare Advantage decisions that are likely to come up fairly shortly here. Earnings volatility and compression. Net income fell sharply from $22.4 billion in 2023 to $14.4 billion in 2024. Right, so they're also with leadership turbulence. Right, they had a recent resignation of CEO Andrew Whitty, and now former CEO, who's now the currently CEO Stephen Hemsley here. So he's meant to stabilize the stock and then institute a turnaround story for this company here. Once again, I have United Healthcare on the daily time frame. We are sitting at golden retracement here, so I do expect some level of bounce up from this area here at the daily time frame. We've been getting a slightly higher trading volume as we're currently sitting around this level here. RSI is at sitting around 43.88. Buyers has been weakening around this area. We're going to see if we're able to sustain and induce a bullish momentum going into this week here. On the weekly time frame, we are still bearish in terms of the MACD. The RSI is sitting around 39.07, so nothing extremely compelling from where we're currently sitting at here. The RSI on the monthly time frame, however, is starting to weaken up, right? So we're seeing a lot of support here at the monthly time frame. RSI is getting very oversold at around 36.24. Of course, you can see here 2 months ago, higher than normal volume. Right now, we're sort of in accumulation zone for the stock for United Healthcare here. All right, so for the third stock, we're going to go over the Trade Desk company here. So this is a high quality, profitable ad tech leader that's also trading at a deep discount after a huge sell-off from its earnings here. So the Trade Desk is a paradox. This is a business with nearly 80% gross margins, 800 million in free cash flow, and a pristine balance sheet. So I'm talking zero debt for this company here. This is a P/E ratio of roughly around 30, which is high by just general standards. But for a company growing revenue at 18 to 25% annually and converting that 27% of its revenue into free cash flow, this is a company trading at historically cheap valuations here. Wall Street seems to think so as well, with an average price target of around $64 here. We're going to go over the bull case. We're going to go over the bear case for the stock here. Bull case is we recently had a big CEO insider buy here. Massive buy here. We have CEO Jeff Green, who purchased 6 million shares for $148 million. So this is the largest insider buy in company history. There's a lot of people in that bear case showing that he actually had a bigger sell-off during higher valuations, but nonetheless, sitting down here, $148 million at lower valuations, growing at over 20-30% revenue year over year. That's a pretty compelling case for a potential buy here. This is a company that is exceptionally profitable and is a cash flow machine. Nearly 80% margins with a 15.3 net margin, and ultimately converting a lot of that revenue into profit here. So very impressive company here. There's also have a fortress balance sheet, like I said, with zero debt and $200 million in cash, right? So they're instituting a buyback. They recently authorized a new $350 million buyback for this company here. Bear case for this company is revenue growth has slowed from 25.6% in 2024 to 18.5%, and quarter four 2025 growth was 14%. So there's the question of increased competition as well as artificial intelligence here. There's also with the departure of their CFO and resignation of a key board member during a critical period for this company here with the advancement of AI and so forth, right? Navigating through this growth deceleration is going to be a huge factor whether or not the multiple can be re-rated for the company here. There's also with a cyclical macro sensitivity here. So TTD's growth is tied to overall advertising budgets, which is sensitive to the economic cycle. So any periods of recession or slower growth for the overall average consumer, that is going to affect the company, the Trade Desk, right? So even though it's sitting at lower multiples, the low can still get lower as we get pressured by macroeconomics here. So the daily time frame looks pretty compelling as well. We're currently sitting around golden retracement. I'm just going to clear that up. We're being supported by the middle of the Bollinger Band, though we are currently right under the 50 simple moving average. I think we're sitting roughly about 9 to 10% away from this 50 simple moving average here. Buyers has been weakening around this area here, but like I said, a lot of these setups are presenting itself right around the golden retracement. We are really oversold on the weekly time frame, however, and on the weekly time frame, looks like we're essentially having a cross from the signal line as well. So potential continued bullish momentum going into this week here. The fourth stock I'm going to go over is Novo Nordisk. This is a high quality pharmaceutical leader facing near-term headwinds, trading at a significant 52% discount to its intrinsic value here. So like I said, the company with a 52% margin of safety is for a reason. The company has recently issued weak 2026 guidance, forecasting a sales and a profit decline, which ultimately triggered that 15% drop in the stock and ultimately several analyst downgrades here. However, we have an average analyst price target about $58, which still suggests a huge margin of safety, 53% away from where we're currently sitting at. Bull case for the stock, deeply undervalued. 51% discount. This is a dominant market position. They are ultimately a duopoly. It's Novo Nordisk and Eli Lilly here in terms of the weight loss medication drugs here. For Novo being Ozempic and Wegovy, and so forth for Eli Lilly here. They have innovative pipelines and launches. With recent launch of oral Wegovy, they have been having a strong uptake in this, right? So 170,000 patients in 30 days. So positive data from CagriSema could ultimately sustain that growth story here. They also have regulatory tailwinds here. Recent FDA crackdowns on telehealth advertisers of compounded GLP-1 drugs is going to help a company with Novo in terms of its branded sales here. So a lot of those compounded medications, the FDA is ultimately going after them here. They also have a share buyback program, and they also pay a healthy dividend for investors here. Bear case for this is deteriorating guidance. Management outlook calls for about a -5% to -13% decline in sales and operating profit. They have intense competitive pressure with Eli Lilly, Zepbound, and Mounjaro, which are gaining significant market share here. So, and it also has superior efficacy to Novo Nordisk here. So 25% weight loss to Wegovy's 15%, but Wegovy being with fewer side effects here. They're also with severe pricing pressure, right? So ultimately with the federal government in terms of reducing a lot of pharmaceutical drugs, they've been needing to reduce the price of their medications, right? So that's ultimately going to press their profit margins, and that's been affecting the company, right? That's ultimately the case for Novo Nordisk here. Looking at what hedge funds have been buying into Novo Nordisk, we have Ken Griffin with nearly a $500 million stake into Novo here. He has an average price of about $25. Jim Simons has 161 million with about an increased position by about 10%. He's up about 40% here and so forth here. You also have Ken Griffin, who has a 377 million with about 136% increase with an average price of about 53.71. Israel Englander is also a buyer for this company here, 82 million. Increased by 66% or 6,661%. So rather bullish for a company like this. Novo Nordisk, also on the daily time frame, sitting at the golden retracement, really oversold on the daily time frame, sitting around 32.79. We are positive in terms of the MACD inflection. Bullish momentum has been coming into the stock here. On the weekly time frame here, we are also oversold, or more so oversold, sitting around 34.64. If we can get sustained bounce into the stock, we might get inflection for bullish momentum on the weekly time frame for Novo Nordisk here. Last but not least, we have Coupang here. Over this past weekend, we had a significant insider buy, which I'm going to be going over in a couple moments here. Going over Coupang here, this is a high growth but low margin e-commerce disruptor trading at about an 18% discount to its intrinsic value, so offering a speculative opportunity for investors who can stomach that volatility here. Coupang is a classic growth at a price story. This is a company that's trading at a high PE ratio of 162, so a lot of sky high expectations for the stock, but does offer a compelling 18% margin of safety here for a company that is growing strongly at about 14% year over year, positive free cash flow of about 522 million, but it has razor thin margins of about 0.6%. So, however, we have Wall Street who are generally bullish for the stock with an average price target about $32. Decent upside from where we're currently sitting at. Bull case for this company, explosive revenue growth. They had a nearly 68% increase in just 3 years here. They are also transitioning to profitability. So just like what we saw with SE, you're seeing that with Coupang as well. They just recently turned a net profit of 200 million over the last 12 months. They have a fortress balance sheet with a low debt to equity ratio of 0.35, $6 billion. And most recently, Director Neil Mehta with a massive $136 million insider purchase just this weekend here. They also have a dominant logistics moat in the core market, so Coupang's AI-driven rocket delivery network in South Korea creates a formidable competitive advantage through speed and reliability. They have that moat because it's expensive for rivals to replicate. Bear case for this company is the razor-thin margins that we discussed, right? Net margin of only 0.6%, so having a lower room for error here. So not much places where things can go wrong that will really affect the profitability of this company here. They also have extremely high valuations here. P ratio of 162 with an EV to EBITDA of nearly 30 is extremely rich, right, for a company that's growing where it's currently at. So they need to continually grow from where we're currently at, but the market seems to be growing in this market here. Looking at significant hedge funds or super investors, we do have Stanley Druckenmiller with a theme with Southeast Asia here. He has a Coupang comprising nearly 30.6% of his portfolio, $159 million stake, and increased his position by 46%, and he's down about 30% in his position here. We're also seeing other significant super investors position itself into this company here. Dodge & Cox with a $1.16 billion stake into this company. Bill Gates with a $218 million. John Overdeck, $135 million. Stephen Cohen with about $145 million, and increased his position by nearly 96% here. Of course, we saw the insider buy most recently by Neil Mehta. Massive buy here over this weekend here. So going over the setup for Coupang here, we are sitting roughly around the middle Bollinger Band, sitting just about under the 50 simple moving average here. RSI is not clearly overly bought or overly sold here, but we did have that significant buy. I expect bullish momentum for the stock here. On the weekly time frame, we are still very oversold at around 31.74. So we're presenting a potentially discounted or disconnect in terms of company's fundamentals to where it's currently sitting at here, right? So buying it about 20-30% under the great Stanley Druckenmiller might be a compelling buy for even shorter term traders as well as longer term traders here. So those are my top 5 stocks that I am looking at for April. Let me know if there's any stocks you guys want me to take a look at. Let me know if you guys appreciated this insight on these companies. And as always, happy trading, guys. Take care.